Welcome to the deep dive. Today, we've got a really packed agenda, a massive, complex stack of source material. We're talking everything from, the roots of American homeownership way back when, through some pretty high-level Wall Street finance stuff, and even touching on negotiation psychology. We are going deep and pretty quickly.
Yeah, and the mission today, really, is to connect these dots. Because at first glance, things like zoning history, they seem totally separate from, say, the mechanics of a 1031 exchange or market arbitrage
Yeah,
concepts.
completely different world.
But they're not. They're all part of this same ecosystem. We want to get under the hood, understand how the actual physical real estate, the rules that shape its value, the financial tricks used to leverage it, and, well, the fact that people aren't always rational, how all that combines. That's how we figure out where the real lasting wealth and housing actually comes from.
That's the challenge, yeah. Decoding the structure of the market itself.
Yeah.
So, okay, let's start right at the beginning. What really defines the American housing landscape? Like the physical reality and the culture around it? And how did that early history, the regulations, shape the market we're in now?
Well, got to start with the dream, the aspiration. If you look back, early 20th century, figures like Herbert Hoover, they painted this really powerful picture. Homeownership wasn't just, buying a house. It was framed as this moral thing, almost. The ultimate goal for pretty much every American.
A civic duty, kind of.
Sort of, yeah.
Yeah.
The idea was owning a home made you a better citizen.
Mm.
It was supposed to lead to happier families, more courageous and responsible people. It really tied private property to public good.
And you can definitely see how that aspiration shaped the physical landscape,
Yeah.
created this very specific American look, right? The scale of it all really stands out in the sources.
Oh, absolutely. It's maybe the defining feature. The data is stark. You look at the average residential lot size back in the 1930s, maybe around 6,000 square feet.
Yeah.
Today, it's closer to 18,000 square feet on average. It's almost half an acre. And what fills that space? The sources specifically call out the mythical entity of the perfect green lawn,
Ah, yes, the law.
that highly managed, high-maintenance symbol of achieving that scale. It's sort of the baseline image of the American dream, physically.
But, okay, underneath that nice green surface, there was this other structure being built, zoning. And while we think of zoning now as, safety, organization, the history in our sources, it paints a much rougher picture. Segregation, class control.
Yeah, the record is pretty damning, frankly. When mandatory zoning really took hold early in the 20th century, the sources say it often had a barely disguised racial overlay, the main tool, reserving those middle-class, wealthier neighborhoods almost entirely for single-family homes.
How did that enforce segregation, though?
Purely economics.
Right.
By forcing large lots and only allowing single-family houses, they jacked up the minimum cost to live there. So lower-income families, white or black, were just priced out, blocked out effectively.
Wow. Using housing type as a sort of proxy for controlling who lives where.
Yeah.
And they
No.
justified this openly, financially.
Completely. It was all about protecting property values. Zoning was pitched hard as the way to stop enormous economic waste. You had towns claiming that without zoning, values would just tank. There's a crazy example in the sources from St. Louis. Property values in some newly zoned areas apparently quadrupled, went from like $18,000 to $75,000 after the rules came in.
Quadrupled.
Yeah. So that narrative zoning protects your investment. It gave these restrictive rules huge power and legitimacy.
And this wasn't just local stuff, right? The federal government, like the FHA, they got involved too. They didn't just allow it. They kind of baked it into the system.
Precisely. The Federal Housing Administration, the FHA, through their appraisal standards, their recommendations, they actively pushed restrictive covenants. Rules saying who could or couldn't live somewhere.
How'd they justify that?
They claimed that integration mixing races or even housing types in a neighborhood lowered property values made mortgages riskier. This led straight to redlining.
Right, drawing lines on maps.
Literally. Shading neighborhoods red, often based on race or diversity, deeming them too risky for federal mortgage support. So by backing this financially driven segregation, federal policy, as the sources say, pushed cities into a more rigid segregation than otherwise would have existed.
So you've got these structures, big lots, zoning rules, FHA policies. They didn't just segregate cities, they physically changed how America lived. Pushed us away from dense cities towards decentralization. We know people like Jane Jacobs championed dense, mixed-use cities, small blocks, parks, diversity, but we went the other way after World War II, didn't we?
Oh, absolutely. We basically traded Jacobs's idea of walkable integrated density for sprawl, fueled by highways, cheap land outside the cities. By 1970, it was a done deal in most big metro areas. Suburbs weren't just bedrooms anymore, they were where the jobs were. The economy had moved. Like in the New York suburbs, the sources say 78% of residents actually worked in the suburbs by 1970.
And the symbol of this new America, the sources call it.
The Beltway, that giant expressway circling every major city, that became the new Main Street for business. Office parks, warehouses, big shopping centers, they all clustered around the Beltway. It cemented this decentralized life where downtown wasn't the center anymore. And understanding that history, where jobs and infrastructure went, that tells you a lot about where demand and maybe value gets created today.
Okay, that historical setup leads perfectly into Section 2, moving from that physical and regulatory structure to, well, financial strategy. Because once you get the rules of the game, you can start thinking like an investor, seeing real estate as a leveraged asset, something to fight that big enemy, inflation.
Exactly. This is where you stop thinking house as shelter and start thinking house as inflation hedge. Because inflation just eats away at your money's buying power. The sources give this incredible example. Take $100,000 cash in 1970.
Yeah.
That could buy you 5 brand new houses back then. Fast forward to 2004. That same $100,000 cash, it buys maybe half a house.
Wow, just half.
Right. So if you hold cash, inflation just crushes you over time. But if you hold the asset, the house itself, its price, tends to track or even beat inflation. It protects that value.
And smart investors don't just use their own cash to buy these assets, right? They use leverage. They use debt as a tool.
That's the engine. Yeah, leverage. Using borrowed money. Think about it. You buy a $200,000 property, maybe put $20,000 down. If that property goes up 10%, that's $20,000.
Yeah.
You didn't just make 10% on the total cost. You made 100% return on your actual cash, your $20,000.
Huge difference.
Massive.
Yeah.
But, and this is the big but, you got to be careful. Especially for things like home equity loans. Pulling cash out of your own home. If that investment goes south,
You could lose your house.
exactly, you could lose your home. So the advice here is very specific. Only use that kind of borrowed money for really clear bargains, things you can flip or sell quickly for a profit, ideally before interest rates jump on you.
Okay, so leverage is key, but handle with care. Once an investor is in the game, holding property long-term, the focus shifts again, right, towards tax advantages, these really powerful, maybe less-known tools, like the 1031 exchange.
Ah, the 1031, the tax-deferred exchange or like-kind exchange. This is honestly one of the most amazing wealth-building tools out there for real estate investors. Basically, it lets you sell an investment property and defer paying capital gains taxes, potentially forever, as long as you reinvest the money into another like-kind property.
Defer indefinitely.
Pretty much. The strategy is often called swap until you drop. You keep rolling your gains into the next property, growing your equity tax-free during your lifetime. Then, when you pass away, the tax basis often gets stepped up for your heirs, meaning they might avoid those deferred taxes completely.
That's incredible for building generational wealth. But it sounds like it needs precision. What are the catches? The time limits?
Ah, yes, the timelines. They're absolutely critical, non-negotiable. You, the listener, need to know this. First, from the day you close the sale of your old property, you have exactly 45 calendar days, not business days, calendar days.
Okay, 45 days to do what?
To formally identify, in writing, the potential replacement properties you might buy. Second, you have a total of 180 calendar days, again, starting from the sale date of the old property, to actually complete the purchase of one or more of those properties you identified.
180 days total.
Total. Miss either deadline, even by a day. The wholesale becomes taxable right then and there. It forces incredible discipline. No wiggle room.
Okay, 1031 sounds great for someone already holding property. What about starting out? Maybe with cash and some hard work? That brings us to this BRRRR strategy. Sounds like a cold noise.
Yeah. BRRRR. It stands for buy, rehab, rent, refinance, repeat. This is all about forcing appreciation. You find a property that needs serious work. Usually buy it below market value, often with cash or maybe short-term private money.
Okay, the fixer-upper.
Exactly. Then you pour money and effort into the rehab, but strategically to significantly increase its value once it's fixed up and you've got a tenant in there paying rent.
Stabilize.
Stabilize, right. Then you go to a regular bank for a cash-out refinance based on the new, higher appraised value. The goal: to pull all of your original investment cash back out. If you do it right, you end up owning this income-producing rental property effectively for free with your initial cash back in your pocket, ready to, well, repeat.
Okay, I see the appeal, but here's a question thinking about the listener. That whole thing depends on the bank agreeing with your new higher value, right? What if the appraisal comes in low? That feels like the big risk.
That is absolutely the key friction point. If that appraisal doesn't hit your target number, you haven't successfully forced the appreciation you needed. You'll have to leave some of your own cash tied up in the deal, which slows down the repeat part. That's why the rehab phase is so critical. Your upgrades have to be things the appraiser will actually value. No weird personal customizations.
Got it. Stick to what the market values. And BRRR ties into taxes too, right? Specifically depreciation, something you don't get if you just flip a house.
Exactly right. If you just buy, fix, and immediately sell a flip, you don't get depreciation benefits. But hold it as a rental. Now you can depreciate the value of the building itself over 27.5 years for residential property.
And that's a phantom loss.
It's a phantom loss,
Yeah.
The loss on paper that reduces your actual taxable rental income, even though you're getting cash flow. But savvy investors take it a step further with a cost segregation study.
Cost segregation. Okay, what's that involve?
Basically, you hire engineers or specialized tax pros to come in and dissect the building, break it down into all its components.
Why break it down like that? What's the benefit?
Huge benefit. Accelerated depreciation. See, the main structure gets depreciated over that long 27.5 years. But things like carpet, appliances, certain light fixtures, landscaping, fencing, even the parking lot, these can be reclassified. They get assigned shorter asset lives, maybe 5 or 7 years. This lets you write off a much bigger chunk of the property's costs way sooner. Massive tax savings upfront, boosting your cash flow now, not decades down the line. It's a really powerful way to shield income.
Okay, that's deep in the weeds, but clearly valuable. Speaking of the rehab itself, all this financial maneuvering is kind of pointless if the actual renovation work doesn't add value, right? It's not just about saving money, but spending it smartly. What are the specific upgrades the sources point to for the best bang for your buck?
Yeah, the market definitely rewards certain things consistently. The sources are pretty clear. Kitchens and bathrooms are key. Modernize them. That means new cabinets if needed. Definitely granite countertops. We should talk about sourcing those and updated fixtures. Tubs, showers, sinks.
Okay, kitchens and baths. What else?
Beyond those rooms, think about light and flooring. Recessed lighting throughout the main living areas makes a huge difference, really updates the feel. And flooring. Replacing old carpet, especially with wood flooring or maybe a good quality LVP, is almost expected now for top dollar or rent. These are the things that justify the higher price.
Let's get practical on managing those rehab costs, dealing with contractors, materials, any specific tips from the sources.
Yeah, you got to walk that line between controlling costs and not becoming a full-time site supervisor. For big-ticket items, smart investors often source materials themselves, especially if they do volume. Like the sources mentioned, maybe you let the roofer handle their own shingles, just for simplicity. But granite countertops, you should absolutely shop that around yourself.
Why granite specifically?
Because there are suppliers out there who specialize in working with investors. They operate on volume, not big retail markups. You can often beat the big box store prices significantly if you find the right supplier. And even small stuff adds up, like fixing drywall patches. If your painting crew is already there, maybe it's $20 a patch. But if you have to call someone out just for that, the cost jumps way up. It's all about bundling tasks efficiently.
Makes sense. Okay, property's looking great. Time to sell or rent. What about this lease option strategy? Sounds like it could be a win-win.
It often can be. With a lease option, a tenant rents the place like normal, but they also buy the option to purchase it later at a price you agree on today, usually within, say, 3 years. For the investor, you often get a non-refundable upfront option fee, maybe slightly higher rent, and the tenant is usually more motivated to take care of the place since they hope to own it. Less hassle.
Okay, sounds good. What's the downside? The risk?
And market timing. That's the big risk. Imagine the local market just takes off after you sign the lease option. Prices jump 15%, 20% in a year. Your tenant? They're almost certainly going to exercise their option to buy at that lower price you locked in a year ago. So you're forced to sell, right, when owning property is becoming super profitable. You basically take your best asset off the table just as the market gets hot.
Right, you missed the upside. Okay, so whether you're negotiating that option price or haggling with a granite supplier or closing the final sale, it all comes down to dealing with people. The sources get into some really interesting kind of counterintuitive stuff from negotiation pros here.
Yeah, and the core idea is pretty simple but powerful. People aren't rational robots. We like to think we are, but we're fundamentally driven by emotions. Irrationality is the norm. You can lay out a perfectly logical, mathematically sound deal, and someone might just reject it flat out because it feels insulting or unfair. Feeling heard is often more important than getting the absolute best number. So the tactics focus on tapping into that emotional reality.
Like using your voice, controlling the tone to manage their emotions.
Exactly. The pros advise against using that assertive, pushy voice. It just puts people on the defensive. Instead, they recommend two main approaches. One is the calm, low-key, sort of late-night FM DJ voice. Smooth, slow, reassuring. The other is a more positive, playful voice. Both signal safety, lower the tension. Calmness itself is often incredibly persuasive.
Interesting. And part of that is empathy, right? Mirroring them, trying to understand where they're coming from, their audience, as the sources call it.
Yes, absolutely crucial. Mirroring is about matching their pace, their pitch, even their vocabulary sometimes. It builds rapport subconsciously. And understanding their audience means figuring out who they are trying to satisfy besides you. Is it their boss, their spouse? Are they afraid of looking weak? Once you figure out their hidden motivation, you can frame your proposal in a way that helps them look good to their audience. Makes it easier for them to say yes. And if things really get stuck, there's always the simplest move, splitting the difference.
Just meeting in the middle.
Yeah. The sources give this example of a huge $4.5 million deal that was completely stalled, deadlock. But it closed almost instantly when someone just suggested they meet halfway. The perceived fairness, the simplicity of it often cuts through all the complex arguments.
Okay, we've hit physical assets, financial tools, negotiation. Now let's zoom out a bit to the wider market, because let's face it, the market often seems to operate way outside logic or reason. This brings us right to that problem of market irrationality. It's a huge challenge for anyone trying to be a disciplined investor.
It really is. And this is where traditional finance theory kind of bumps up against reality. The classic idea, the efficient market hypothesis, basically says rational investors will always correct prices through arbitrage.
Arbitrage meaning buying low, selling high simultaneously.
Right. If something's clearly overpriced, rational people sell it. If it's underpriced, they buy it, and boom, the price snaps back to its correct value. That's the theory. But behavioral finance folks look at the real world and say, hold on, arbitrage has serious limits.
How is it limited? If a stock is obviously too cheap, why isn't everyone just pile in until it's priced right?
Well, a few reasons. First, irrational investors can stay irrational longer than you can stay solvent, as the saying goes. They can keep pushing prices further away from reality. Second, arbitrage isn't free. There are costs, and it's risky. What if that cheap stock keeps getting cheaper because of panic selling? The rational arbitrager could lose a lot of money before the market corrects, if it corrects. So those limits, risk, cost, timing, mean the market doesn't always self-correct perfectly or quickly. Irrationality can persist.
And we've definitely seen proof of that, herd mentality just taking over. The sources talk a lot about the late 90s dot-com bubble as a prime example.
Oh, that era was just nuts. Pure mania. The market was running on hype, not fundamentals. At the peak, the sources say the ratio of analyst ratings was something like 100 buy recommendations for every single sell. It was completely skewed.
100 to 1.
Yeah. Analysts, even if they privately thought stocks were wildly overpriced, were basically incentivized to keep the party going. You had those famous cases like Jack Grubman, Henry Blodgett. They faced investigations, huge fines later, for allegedly pushing stocks to win investment banking deals for their firms. It just showed how fear and greed can totally overwhelm rational analysis in the market. Discipline is hard when everyone else seems to be getting rich quick.
So faced with that kind of potential chaos, a lot of investors turn to more structured, rules-based approaches, right? Trying to avoid those emotional pitfalls, things like indexing or these newer smart beta strategies.
Indexing is still sort of the bedrock of disciplined investing for many, just buying the whole market or a big chunk of it.
Yeah.
But the sources offer a useful tip here. Don't just default to the S&P 500.
Yeah.
It's popular, sure, but it leaves out thousands of smaller and mid-sized companies. And those smaller companies are often where a lot of growth and dynamism comes from. So the recommendation is to look at broader indexes like the Russell 3000 or the Wilshire Total Market Index. Get more complete exposure.
Okay, broader indexing. What about smart beta? That term's been everywhere lately. What is it exactly?
Right. Smart beta. It's basically rules-based investing, like indexing, but instead of just weighting companies by size, like the S&P 500 does, it selects or weights stocks based on specific characteristics or factors that academic research suggests might lead to better-than-market returns over time.
What kind of factors?
Things like value-buying stocks that look cheap based on their fundamentals. Momentum-buying stocks that have been performing well recently. Size, historically, smaller companies have sometimes outperformed larger ones. Quality, focusing on companies with strong balance sheets and stable earnings. The idea is to try and capture these potential return premiums systematically without taking on way more risk than just owning the whole market. It's trying to be, well, smarter than simple indexing.
Interesting. So whether we're talking complex real estate deals or these factor-based funds, it sounds like success always circles back to personal discipline. And the sources take a sharp turn here, connecting investment strategy directly to, like, personal identity. It's not just about what you do, but who you become.
That's exactly the argument. It reframes habits. Habits aren't really about getting something, hitting a portfolio target, losing X pounds. They're fundamentally about becoming someone. Every action you take, every investment decision, every time you stick to your plan. It's like casting a vote for the kind of person you aspire to be. A disciplined person, a rational investor, whatever it is, you build the identity through consistent action.
But starting those actions, especially big ones, is hard. We all procrastinate. How do the sources suggest overcoming that initial inertia?
With a really simple but effective trick, the 2-minute rule. It's designed to fight that feeling of being overwhelmed when starting something new. The rule is, whatever new habit you want to build, the very first step should take less than 2 minutes to do.
Less than 2 minutes? Like what?
So if your goal is research real estate deals daily, the 2-minute version is just open the website with the listings. If it's work out every morning, the 2-minute version is put on your running shoes. It's not about achieving the goal in 2 minutes. It's about making the starting ritual so easy, so frictionless, that you can't not do it. It lowers the barrier to entry dramatically.
That makes a lot of sense. Get the ball rolling. And behind that action, there needs to be accountability, right?
Yeah, absolutely. And ultimately, the most important accountability is to yourself. You need that mental honesty to look at your process, your results, and own them, even if the market went crazy or the contractor messed up. The key tool here, according to the sources, is the execution measure. This isn't about the final outcome, like how much money you made. It's about tracking. Did you actually do the things you identified as most important? Did you make the calls, do the research, stick to the plan? Knowing you executed on your process, that's tangible progress towards your big goals. It connects those small 2-minute actions back to the long-term vision. Okay, now, as we move into this next section, we need to address some interpretations offered in the sources regarding the forces that might be behind some of the market irrationality or social structures we've discussed. Some of the material presents a view that these things aren't always just random market noise or historical accident. They might be influenced or even engineered by powerful groups seeking control. We absolutely have to approach this part with critical distance. Our job here is just to report on the theories as they appear in the texts, without adding our own judgment or endorsement.
Right. That disclaimer is important. We're shifting from internal discipline and market mechanics to theories about external power structures. So what are these specific theories about external control that show up in the sources?
Well, one recurring theory describes what the sources call a global cult. This isn't meant literally in a religious sense, but more like a group operating with a specific mindset, which they label Wetiko consciousness.
Wetiko consciousness. Can you explain that term as the sources use it?
Yeah, in this context, Wetiko is used as a metaphor for a kind of psychic virus, an extreme form of self-serving greed that's inherently destructive and exploitative, almost like spiritual cannibalism. The sources claim this Wetiko consciousness drives this alleged cult, making it fundamentally anti-human in its goals and operations.
Okay. And according to this critique, how does this alleged cult supposedly exert influence? What's the mechanism?
The theory laid out is that this group actively funds and directs a vast network of what the sources term woke organizations. The stated purpose, according to this view, is global transformation and establishing control. The critique asserts they operate with a sickening disregard for human life. The implication is that some of the social trends, market volatility, or even political shifts we observe might be part of this larger hidden agenda.
Are there specific examples given in the sources? How do they interpret recent events through this particular lens?
Yes, the COVID-19 pandemic response is a major focus of this critique. The sources point to the reported drop in diagnosed cases of ordinary seasonal flu worldwide during that period. They suggest this wasn't because the flu disappeared, but because symptoms were perhaps readily diagnosed as COVID-19, implying an almost unlimited potential for diagnosis. Measures like masking, lockdowns, or house arrest, as they term it, are framed not as public health measures, but as tools of fascist tyranny. The sources criticize the media for not questioning the flu's disappearance and call for dismantling institutions, like the UK's NHS, seen as part of this system.
And how does this critique portray prominent global figures, particularly those in tech or philanthropy?
Well, figures like Bill Gates and Elon Musk are specifically named. The sources characterize them as displaying limitless Wetiko arrogance. The claim is they believe they have the right to fundamentally reshape the world, do whatever they like to the world because they own it, with little or no concern for the consequences for humanity. It's argued that these individuals aren't acting purely on their own behalf, but are essentially operating as conduits or vehicles for this broader Wetiko force, with their own well-being being secondary to this alleged destructive agenda.
Okay. Given how extreme and charged these theories are, it's really vital we pause and restate our role here.
Absolutely crucial. We are simply reporting on the content and the specific viewpoints expressed within the source material we reviewed for this deep dive. Our aim is to present the range of ideas found in those texts. For you, the listener, this section really highlights something critical: the absolute necessity of engaging your own critical thinking. Question everything you read or hear, especially when it comes from highly charged, adversarial, or conspiracy-minded sources. Perhaps the biggest takeaway running through this entire discussion is that you need to constantly question the motivations, stated and unstated, behind any information presented to you, whether it's a glowing stock recommendation or a sweeping theory about global control. Hashtag tag outro.
Wow. Okay, we have covered a lot of ground. From the American law in the 1930s to negotiation tactics in multi-million-dollar deals and ending with some pretty intense theories about global power. Let's try and pull the key threads together. What are the main takeaways for someone trying to navigate the world of real estate and investment?
I think first, it's clear that building wealth in real estate requires mastering both the internal game and the external mechanics. Internally, it's about discipline. Externally, you absolutely have to understand leverage, how to use debt wisely. And you must get savvy about tax strategy, depreciation, cost segregation, the 1031 exchange. These aren't just minor details, they are fundamental wealth accelerators.
And all of that happens within a specific history, right? You can't ignore how things like zoning and FHA policies actively shape the landscape, creating winners and losers and embedding segregation in ways that still affect value today. That context matters.
It absolutely matters. And connecting back to the internal game, success really demands that you cultivate the identity of a rational, disciplined investor. Whether you're facing down a crazy market bubble, choosing a simple broad index fund instead of chasing hype, or using that calm FM DJ voice in a tough negotiation, it all comes down to emotional control and sticking to your process, starting with things as small as that 2-minute rule.
That internal-external balance feels like the core theme. Whether you're just starting out, maybe buying your first home, or you're managing a whole portfolio, you need both things. The knowledge of how the system works, the markets, the laws, the loopholes, and the internal fortitude, the discipline, the emotional detachment, the consistent execution.
Exactly. And that brings us to our final thought, something for you to chew on. We saw how government actions like zoning and FHA policies historically created more rigid segregation than otherwise would have existed. We also see how political power itself, like with figures such as Robert Moses, who reshaped New York, can drive massive outcomes, sometimes quite separate from market forces or popular opinion. So the provocative question for you, as you navigate your own financial life as an investor, a homeowner, just someone trying to build security, is this: how do you personally manage the inherent tension between your individual pursuit of profit and opportunity and these powerful, often unseen or irrational forces, social structures, government regulations, political power, that inevitably shape the playing field and define the boundaries of what's possible for you?